Welcome to 3 Minutes on Markets and Money. I'm your host, Lance Roberts, talking a little bit about how to add exposure for the Santa Claus rally. The age-old adage is, how do you pick up a porcupine? Carefully. And that's exactly what we're doing with the markets here. When we take a look at the markets currently, on many fronts, the markets are extremely overbought and extremely deviated from long-term moving averages, long-term trends. Typically, these are areas which generally constitute the positioning for a pullback or a correction in the markets in the short term. However, because of the Federal Reserve's ongoing liquidity push, this has wound up not only pushing markets higher, but also really suppressing volatility here. And as we head into the end of the year, the Federal Reserve is going to be increasing their repo actions by almost $100 billion, taking the balance sheet in total up $500 billion as we go into January. That liquidity's got to go somewhere, and very likely over the course of the next, 4 to 6 weeks, we could certainly see the markets move a bit higher. Notice that historically, we're at very, very big extensions from the long-term bullish trend, even greater extensions than what we saw back in 2007 and about what we saw back in 1999. By the way, in 1999, last 2 months of the year, that was when the Federal Reserve was increasing repo actions into the markets in advance of Y2K. And of course, that was when the NASDAQ rallied 100% over the course of just a couple of months. Of course, that also marked the end of the dot-com bubble, but that's a story for a different day. Currently, the extensions are very high here, so we're likely going to see a corrective action sometime in 2020. Between now and there, we do need to add some exposure very cautiously in order to participate with this market. So how do we add exposure to the markets at this late stage cycle? As I said early, very carefully, here's the rules to follow. 1. Move slowly. There's no rush to adding exposure. If you're underweight equities, well, don't try to fully move into full equity exposure all at once. Look for opportunities. Move slowly. Start by selling laggards and losers. Those that have been underperforming on the way up, well, they also tend to outperform on the way down. Add to sectors or positions that are performing with the markets or outperforming. Move stop loss levels up to current breakout levels. Tight stops will keep you out of trouble in case something goes wrong unexpectedly. And while the technical trends are intact, as I said earlier, risk is considerably elevated. And if none of this makes sense to you, well, this is why you should hire a professional to help you do this better, somebody that has a sell discipline and a program in place. Here's the important point. As portfolio managers, we have to add exposure, or we potentially suffer career risk if we don't perform with the markets. But you don't have to. Just remember, this market is very long in the current cycle, very extended for long-term means, and corrective actions will likely be much more brutal than people currently expect. So make sure that you pay attention to your portfolio and manage your risk properly. That concludes 3 Minutes on Markets and Money today. We'll see you next time.